Hey, good morning, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for October 1st, 2023. I can't help but wondering where the time goes when on January 1st, 9 months ago, I started the hybrid swing portfolio speculatively. I said, well, let me just start doing that thing to see how it goes and see if that's that will catch on. That's the best thing I've done all year. So it's amazing how much you can get done with little pieces and parts and just get going and see what happens. So, our top level idea, plan, prepare, makes you ready to execute, and then assess if you still survive. So, that's all good. I had a question from Mullen. This one is about the oops, blended monthly rebalancing. So, blended monthly rebalancing, how to do it. So, that is taught during the core course, along with a bunch of other ideas and many of the variations. It's really part of this position trading. Uh, we do swing and day trading, and then core and turbo trading. That's what makes things hybrid. Uh, the blended monthly rebalancing is a monthly adjustment. It uses a database and some of our indicators, the tortoise index or the strength index, I should say, to broadly classify the market, and then a whole bunch of ETFs that are liquid and completely cover the world market model. And then we update that thing weekly to give us insight for swing trading. It helps us update an ETF2 hedge fund system, but it also helps us with the monthly rebalancing. The three sample portfolios I start off with, ETF 13, 22, and 32, are different sets of exchange traded funds that cover the world market model in a certain way. So the ETF 13 is the basic one. It has like five U.S. indexes or maybe six U.S. indexes and six or seven globals. So when you start laying those ETFs onto the world market model, what you have is coverage of the whole world. And then what we do is we rank them based on strength over the last 3 and 6 months. And we take a 70% blend of the rate of return of 3 months and a 30% blend of the 6 months. We combine those, and that gives us the blended percentage for that month, or for that time period. We then rank those uh, from best to worst. We scale it on a scale of 0 to 100. And we call that the strength index. So the strength index then is all of the members of a portfolio. So we might take 13, calculate the 3 and 6 month percentage, make a blended percentage, rank them 1 to 13. We set the strongest one equal to 100, the weakest one equal to 0, and then based on math, you plot them on that thermometer scale, and then that gives you the ranking. And then in the blended monthly rebalancing, we want to own the top three, and we want to hold them in equal dollar amounts for 1 month until the next month. So we run this. Now we have one additional piece of risk management, and that is the 4 month moving average. when when times are good, price is going up, and price is higher than the 4-month moving average. So when we calculate the database each week and we score 1, 2, and 3, we also check to see are they above the 4-month moving average, which makes them ownable. If they are below the 4-month moving average, then they should be in cash. If they are above the 4-month moving average, their own moving average, then they can be owned. If it comes to pass that the top three, compared to their peer group, are below their 4-month moving average, instead of buying that one for the month, you hold a cash position. So you could hold 1/3, 2/3, or 3/3 cash position. That's been the case for the month of September. So I want to say that you don't go down to the next one that has a cash position, for instance. Like you don't come down, number 5 or number 6 is above its 4-month moving average, so I want to own it. Unless it's in the top 3, you can't own it. And you can only own it if it's better than its 4-month moving average. And then the goal is to have 1/3 of your Whoops. Hit a button there. Is to have 1/3 of your portfolio in each one of them, approximately. Now, what'll happen is that you have position 1, and maybe you got that in June, and then in July, and August, and September, it's still on the list. So we just roll that over. Sometimes you got to change from fund 1, 2, and 3 to 3, 4, and 5. And Mullen's question was, how do you do that? So normally, you just keep 3 because he's going to be approximately 1/3. The goal is to have that rounded off into thirds. But in practical terms, sometimes that means, I've got to sell $15 worth of this ETF to roll it over into the other one. So don't monkey around with that. Make approximately 1/3 is the standard rule of practice. So I say that to say this was Mullen's question here. So at the start of September, it was Qs, the SPY, and MDY. And so the target allocation was 5K in each one. When he went to buy those, I don't think his broker allows him to buy fractionals. So first of all, get a better broker. But he was able to buy approximately 5,000 of each one. And now, because of market price movement, the portfolio lost $1,000. And at this point, it's Qs, SPY, and ILF. How does he handle the portfolio change? Do you leave the Qs and the SPY are still in the portfolio with some value, but what you're doing is you're swapping MDY for ILF. The simple way to do it is sell MDY, buy as much ILF as you can with the cash that's in the position, provided that ILF is above its 4-month moving average. It is not. So that instead would go to cash. Now, in the evolution of the BMR, we've said one option for exits during the month is to have a 10% trailing stop on each position. And as long as that 10% trailing stop from the highest high was still good, even if that position went to below the 4-month moving average, don't sell it because you had the reasonable stop protection in, and that reduced some of the friction in the portfolio. Because sometimes when you buy it, Like we don't want to use the 4 month moving average as a stop loss because sometimes you buy that position and there's only 1% from it to the 4 month moving average. And then it could go down in a couple days and then you'd end up selling the position and then it recovers during the month and that would drive us nuts. So one thing we've just said was, look, you could either just have a 10% trailing stop for the month. Then if that ever gets hit during the month, you just put that money in cash and leave it until the monthly rebalancing. That's a good plan. Another one is the 4 month moving average. That's, I don't think, as good a plan because you you have to sell sometimes early in the month. So as long as it was above its 4 month moving average, it's healthy enough to own with the 10% trailing stop. The other thing we said was that if that monthly position ever earned 15%, make your trailing stop not 10, but move it to 5 because that's such an exceptional gain. You want to bank an extra piece. So this is intended to be a simple system. Administratively, to make it simple, in this case, I would just roll MDY into ILF and be done with it. There are some times when one position gets so good that it's much better than the other two, in which case you could sell pieces and then bring everything up to parity at the start of the month. That's not a bad plan. So keep it simple. The rules are in the foundations course for following that system, but that answers Mullen's question. Before I go any further, any questions from you guys on what I just said? Okay.
Yeah, I have a little clarification on
Sure.
the ILF,
Yep.
which you said is under the month moving average in there.
If it were, if it
Oh,
were,
oh, I thought you said it was already,
well,
and
they
that why
all
it
are
was
right now. 100%,
right.
all 10 or all 13 of the ETFs are under its 4 month moving average, so none of them are ownable.
Okay. So how would you handle that
I
if
would
it
go to
was
cash.
all of them go to cash?
Yep.
Okay.
I treat it personally. Personally, I treat it as if each month I'm buying the portfolio. Can I buy that thing right now? No, don't buy it, and I just leave it alone.
Okay.
Other variations of this that are not tied to the calendar, or maybe slightly less tied to the calendar, is that uh, it's using the wrong. Is I divide the portfolio into four chunks, and then each week I adjust 1/4 of the portfolio. So I get a blended version of this thing going through the month. But then I hold that thing with a 10% trailing stop until it's time to rebalance that portion. Because I look at this thing every day because I'm a maniac. And I update the statistical database every week anyway because the strength percentage, which I use, comes from the ETF2 system, which looks at strength, consistency, and quality. 3 different measures of that giant database. I use the strength index from this system to drive the BMR. But this is a weekly system. So I'm calculating those numbers every week anyway. And I don't like holding on to things blindly for a month. I'm just too nervous. So I just break it into 4 pieces and adjust 1/4 of it weekly. And so I increment through the year. Anyway, that's an entirely different course, but I I made the rule set available on Foundation, so you can take a look at that. I'm happy to talk about it more, but I have some other things to get to today too. But there are as many variations of this system as there are people. This is another example of one of those that, hey, the BMR system itself, the vanilla system, outperforms the S&P 500 at 1/3 of the risk. And I briefed that system in about, I can brief it in 5 minutes. I just did. And people are, well, have you thought about this? Have you tried that? Yeah, I have. So, in fact, Bill Scheit is teaching a course for VTI on his personal implementation of the blended monthly rebalancing. He has added some personalized rules that he's developed over the last 15 or 20 years. He's come to the annual research weekends, tweaked his own rule set, presented research and findings on it, and has been using it for 15 plus years to guide his son's college fund and his wife's retirement fund and his own retirement fund. He's now teaching that course for VTI. It has a few more tweaks than what I just showed you. It shows his personal implementation. But he's going to teach that as a course for VTI. It's a pretty good course, by the way. I can say that. It's so good that I'm having him at when VTI closes its doors. He's going to teach that for me in our OWL group. So anyway, that's that. Did I answer that question, Jonathan?
Yes, I'm satisfied.
Oh, okay, cool. All right. Lou asked this about some definitions, specifically these. Two of those, I think, were not in the standard risk and the R10 are not in the glossary 4.0. They are being added to 4.01 because those are newer terms of art. But I thought that I would put them all in context because this is the foundations course after all. So the main thing I want to say, and I added these because I wanted to talk about them too. The main thing I want to say is I approach trading in all time frames as industrial production, which means I want to be able to scale, use rules, and I want to use total quality management, by Dr. Deming and the whole crew to get continuous improvement. And the style for that is Japanese manufacturing, Kaizen in the Gemba, or what is described in the Toyota production system, and which is really well articulated in the great book, The Machine That Changed the World. Toyota produces and manufactures better than anybody, except maybe Tesla. It's getting close. There are some ideas that Tesla does for robots that Toyota hasn't done yet. The Tesla quality is beginning to approach Toyota, but the book, The Machine That Changed the World, described this spirit of continuous improvement. And Kaizen is the Japanese term for micro improvements. So what Toyota does is every 4 years, they completely redesign the car. So when they design it here, that thing's going to go through, they're going to produce that form of the car for 4 years. And along the way, they're using their little quality circles. They're going to use Kaizen in the Gemba. The Gemba is the workshop. So the guys that are doing the work are making micro improvements. And so essentially in year one, they're learning how to make this brand new car that has incorporated all of the great technology. And they use a process called kaikaku for large changes. So all of the, once they commit to this, they're only going to make micro improvements. So while all these new technology pieces are being invented, they don't try to jam that in. Instead, they send that to the large scale redesign, kaikaku, and that goes into the design of the car that they're going to produce in 4 years, 3 years, 2 years, and then finally 1 year, and then it's the new model year. So they combine grand design and modernization and updates with a spirit of continuous improvement on the hands-on workers who are they're learning how to do things slightly better, how to nudge. So when I take the PSAR and I go from point 2 and point 12 as the settings to point 2 and point 14, that change from point 12 to point 14 is Kaizen. Because as I was working on that, it fixed a problem that I had. And the problem that I had was that on a good reversal, when the RL10 would come up here, it would cross the dragon and the PSAR would be up in here. And so it was driving us nuts, saying, where can I buy in here? Do I have to wait for the RL10 to get through? Can I go when price gets through? Can I buy earlier? You know, all that stuff. So when you make the change to 0.14, after a significant harsh winter, that by the time we're ready to buy, that brings the PSAR down equal to the north shore of the dragon. So now you can buy it. It simplifies it. You can buy it a little bit earlier, which is what we wanted. So that little change is Kaizen. When we changed the data source from price to the moving 10-period regression line and said, use the RL10 equals the price, and then use that to calculate these numbers, that was a major design change in how to use the PSAR, which made it brilliant. That's an example of kaikaku. When I make micro changes, that is Kaizen. All of that is a feature of thinking about trading and systems and rules and processes as a form of industrial production that a bunch of trained monkeys like us can just go to work, go into that process, and produce quality because of the way we've designed the machine that they are operating. But we know that they're not just monkeys, that monkeys can think, and they can see ways to improve the process. That is Kaizen. This is the Gemba, the place where we do the work. That comes from the principles of total quality management. So his 14 points on how to install a culture of quality in the way you do things forms the basis of my entire approach to trading and the design of trading systems and the training of traders, and why I use the nightly podcast as the Gemba where the work is being done. Well, if you're going to industrial produce, I just remember Bill Slater, our shop foreman, would say, well, are you making good parts? I said, yeah. He says, how do you know? I said, because I have a gauge. Every 10th part I take over and I put it on the gauge, to make sure it's still within spec, the machine hasn't drifted. It's still making good parts. Well, how do you know the gauge is any good? Well, because every day I calibrate it against the standard. How do you know the gauge block is any good? Because you calibrate that, Bill. And that is used to calibrate everything in the shop. So there's an infinite loop of designing quality into the process. Well, there's other ways you can do that, but like you can design a process so that it can't make bad parts. Like all the setup conditions have to be true, otherwise the machine won't work. So if you have a bender that has 17 stations and you're going to take a straight piece of pipe and you're going to put it into the machine, when you first put it in to make the first bend, it has two little lasers, three-dimensional, and the endpoints of that piece of pipe have to be within that small sphere, which says that the pipe is straight and it is allowed to be bent. But if it's not, if the endpoints aren't within that little three-dimensional sphere, a red light comes down and the entire machine is stopped because something happened. It's either the piece of pipe is bad or some monkey with a backhoe bumped the machine and knocked it out of true, but this thing's not ready to be bent, so we stop the whole line until we find out what's wrong with that. And then now you can bend it and then rotate it to the new station. Before you rotate it, you check the endpoints again and said, did it make the bend correctly? Are the endpoints now in the new location correct? And is that true for all 17 stations? If so, it rotates one slot to the right and you continue to make quality parts. It can only make good parts because of the way you designed a system, and that way you protect the monkeys from their own variation. You have eliminated the variation from that part of the system. That is what industrial production is looking for, is how to improve the rules and how to improve the machine, and you do that through Kaizen with micro changes and Kaikaku for grand design changes, and Toyota figured out how to do that because after every 4 years, that fourth model year was so good that these guys were running out of things to improve. But at the same time, there was enough new technology that was mature enough to put into the new car that it was time to put that in. And it turned out that Toyota figured out that the 4-year cycle was perfectly timed to the development, design, and production of cars, and that was the right battle rhythm. As a trader, does that mean we should be reaching? No, it means that we need to know what the battle rhythm for changes are, and are we looking for continuous improvement in the Gemba, and are we scanning the horizon for other big ideas? Like, hey, AI, we didn't have that 4 years ago. What can we do with AI that might improve the process going forward? That's Kaikaku. All of that comes from a lens of industrial production. So when I write a 350-page book on the foundations of our trading, there's probably 50 pages in there that talk about this and the idea of standard work. That I just want the little guy coming to work, the trader, I want him to know what his job is. The trader's job is to pull the trigger when the entry is signaled. That's all. And then the fireman has to come in, and his job of standard work is to get us to no lose plus dinner for two. To save, because if we entered that position right here and we're taking that much risk, the fireman comes in and moves the stop to here so that we can lock that in, and then those two guys go to rest, and now the manager comes in and his job is to ensure that we are following the PSAR or whatever we're using for the relaxed managerial rule, whether it's the PSAR or the Bollinger Band mean, the 30 period average, whichever one of those you're using is the manager's exit, purely rule based, his job is just to make sure that we do that. The sniper comes in and says, when this thing gets to 2R, this is now an abnormally good. Why do I say that? Because the average win is 0.7. So I don't even wake my sniper up because I am thinking. I have to think when I'm using the sniper exit. I'm reading the individual chart pattern and I'm applying a lot of different considerations as a craftsman to the situation to decide where do I want to put my stop. If my stop is, let's just say that I'm using the PSAR. If my manager happens to be using the PSAR by rule, but price is up in here and I see the two dragon horns that are well outside Z plus 3 in the Bollinger Band framework, I say, oh, that's a sign that this was an asymptotic move. And when that thing starts failing, I know that as a sniper, I'm supposed to take that exit. So now the sniper's job, what's his standard work? Is that when he's activated and he sees the dragon horns, he knows to take that shot. What other rules does the sniper have? A bunch of them that are conditionally based. What are all the things that I think about when I think about exiting an abnormally good position? Money management, market condition, time of day. What are the peer groups doing? What is the average move of this target? Where are we in the range stat for the day? A dozen things. And the sniper's going to take the shot. Hey, if you do that 100 times, you might come up with a whole bunch of different little conditional things. Half the time, when I take the sniper exit, that thing comes down and it hits the managerial exit. And I say, that's good. The sniper saved me this much money. I got that much extra money because of the sniper. Half the time, it doesn't go to the managerial exit and reverses and goes higher than the sniper exit. And then it looks like the manager is smart because the manager didn't get chased out. It stayed in. So now I need a rule that says, how do I decide which one of those I'm going to do? So I just say, look, if I get above 2R, I take half with my sniper, which is judgment. Whatever it is, I'm committed to honoring the sniper's judgment, however I'm feeling. I take half the position, and I have half the position with the manager. I'm done thinking about it. I just take the sniper shot, and I leave with half, and I leave the other half on. And I just live with it. That means I have to have a chief of staff. What's his job? His job is to make sure that I just do standard work on what I call the Wu-Wei exit, which is the combination of the sniper and the manager. The chief of staff's job is to decide, should I use the Bollinger Band mean or should I use the PSAR? Or should I use the southern skin of the dragon or the northern skin of the dragon? The chief of staff makes a decision as soon as I get past the average That's what he tells the manager what to do, and I just follow that one, and I never go lower. If I decide it's going to be the manager, it's the manager. If it's not the sniper yet, but I said I feel like the Bollinger Band, so the chief of staff just makes those override decisions whenever I get past an average win. That means I need to know the average win so that I can perform this kind of standard work in my workshop of industrial production. Lou asked, dragon horns, assume the two bars close toward the bottom of the bar. Yeah, so there's an infinite number of questions like that. Here's how I treat it. Price has to be beyond the Z3. And what we've noticed is that on an asymptotic move, it'll look like this. And I see two highest highs are north of the Z3. As soon as that happens, I want to exit at the Z3. Automatically. Hey, what happens if it almost gets there? Well, then I look for a 1, 2, 3 exit. What's a 1, 2, 3 exit? It's in the glossary. It says, if I have the highest high on that bar and it closed here, and let's just say that it opened here because we're on an intraday. Whenever this thing closes, then I know if this is going to be bar 2. This is tentatively bar 1 because it made a new high. I don't know that it's bar 1 until I see the close of bar 2 and I can see where the highest high was. If it did not make a new high, then this is bar 2 and then this is bar 1. And now wherever bar, and that makes this bar 3. Wherever bar 3 is, and it's live, I take the exit when it goes below the low of bar 2 while bar 3 is open. That's a 1, 2, 3 exit. A 1, 2, 3 entry is reverse. It made a swing low. Bar 2 closed, and this was higher than the low of bar 1. That makes this bar 2. That makes this bar 1. And then then bar 3 is this one. And then if this price opens here and then marches through and goes north of this, there's my 1, 2, 3 long. It's also the 1, 2, 3 short on a, if I'm trying to, I'm sorry, it's the 1, 2, 3 exit on a short position. 1, 2, 3, I'm out right here. Hey, sometimes that bar was so big and it closes here, I just decide I'm going to cut it in half. I'm going to keep half. That's a sniper decision. And I'm going to exit inside this bar if it retraces half. Sometimes the high is up here and I just say I'm going to hang an MMRB because the total amount of gain that I had, I only want to risk, I only want to give back 1 MMRB, and then no matter where that is, I just put that on. That's a sniper decision. How many of those are there? As many different ideas as there are in my head, based on how I feel and how I think, as I'm looking at that market sector, target, peers, time of day, total portfolio heat, gains so far, day of the week, day of the month. That's what the sniper is doing all the time. That kind of discretionary judgment. That's exhausting. Do you want to try to turn all that into a unique rule and then program? You can. It can be done. I don't. I just said, instead of worrying about that, when it gets above 2R, I put whatever my sniper says, I'm going to honor that with half the position. And then whatever the manager says, I'm going to do that. My chief of staff can make a decision to upgrade the manager and use one of those lines. The PSAR, the lower skin of the dragon, the spine of the dragon, the upper skin of the dragon. One of those four is going to be my conservative rule-based exit. Like in the last month, you guys have seen me hitting this idea hard that price moves down, the RL10 reverses, and as soon as the RL10 reverses, you have seen me routinely taking the exit at the edge of the dragon. Routinely. It's always better than 1R in hand. So if I got +1 and I see that turn, I just invoke the edge of the dragon and I take the whole position. That's what I'm doing in the hybrid swing system on 30-minute bars. That is so good that I may do it on other time frames. I don't know. But for right now, for that one system, that is my routine dragon exit, I've been calling it for the last month. Have I written that down? Nope. Because I'm still thinking about it and I'm still trying it. This is the closest to writing it down that I've been so far, telling you that's what I'm doing in the hybrid swing on 30-minute bars. Why is that? Well, because on 30-minute bars on the intraday trade, that is significant in the RL10. When it can do that, that is significant. That means for 30 minutes, that price did not continue whatever gained all that money. It did not do that. In fact, it reversed. That tells me I better be on my best behavior to get out of it. How much should I give back? Well, there's two ways I can answer that. I can take the same MMRB that I used for the initial risk and hang that off the bottom, and I can give back a full MMRB, or I can just take the dragon. What you will almost always see is price looks like this on that kind of formation. The morning event happened and it gives you this big stupid move, and then maybe the last one is a big bar. I don't know, maybe it isn't. But then this thing just starts drifting. And while it's drifting, that 10-period Bollinger Band is just cruising down here. And this is good enough. And that's quite often closer than a full MMRB. So this is actually an improvement. But I'll tell you, when I see a great big bar, and then that thing, it's like a bottoming tail. It opens here and it sells off hard, and then it starts coming all the way back up. At the halfway point, if that's an MMRB off the bottom, I'll just take it inside of this bar, because it's a bottoming tail. That means the last gasp of selling happened, and now these guys didn't even wait inside that. That means the 1-minute traders and the 15-second traders and the algorithmic guys all said that was a really good buying point. So I'm not, if they already have moved on to they were the guys that were selling it. If they've already moved on to the buy side, the first mouse has spoken. And I'm going to only give back 1 MMRB. That's a money management stop. That's not stupid. Guess what? If you got plus 2R in hand, that's a 1R trailing stop, isn't it? Yes, it is. So that's not stupid. Look how I just simplified that. Just use a 1 MMRB trailing stop after 2R in hand. Done in one. That's an example of guys sitting in a quality circle and doing Kaizen. Instead of all these god dang rules, Ken, one line of code, of pseudocode. Done. How do I know when I have 2R in hand? Really? Really? How do I know if I have 2R in hand? I have a gauge. Whatever that wrist box was, you've seen me put that little stamp on it that's calibrated to the size of the wrist. So I know where the 2R is as I enter the position short. I know where 2R is already. I know where the average win is. I know, and that tells me when I'm supposed to be going from here to here. When I'm getting close to 1R in hand, that thing, when it crosses the 1R threshold, if I haven't moved to no lose, I move to no lose. Plus dinner for two. Why is that? Well, because there's my risk, and if my average win is 0.7 and I'm at 1.0, I don't want to give back more than an average win. I don't want to let an above average win go to 0. So mathematically, when it gets to 1.0, I have to move from a -1 to 0.2 or 0.3. Now, if it comes back, it loses an average win. I still have something. Psychologically, that's important. So there's a rule. At 1R, go to no lose plus dinner for two. At 2R, trail 1R. Done. You like those rules? I do. Does that mean I'm going to stop thinking about the sniper mentality forever? Nope. Because how did I find those rules? By continuing to scout and to snipe around and figure out stuff when I get beyond 2R, which is the abnormal gain. Because I want to keep more of the abnormal gain. So that I just described was standard work for my scout, my sniper, my chief of staff, my manager, my fireman, my trader, my architect, my blueprint guy, my radar, my accountant who tells me how much money I can put on there. Every one of those is on my team at his standard work and making me figure out what I got to do. Frog box. All right, so this is coming from the world of the standard day. Sorry. So, the standard day. Here's where it closed yesterday. Here's where it opens today. There's the open. This blue bar means that's the opening. So, I measure What's the difference from where it closed to where it opens? That's the gap. I go back 30 days and I find the absolute value of all of those gaps as a percentage. The average absolute value percentage of gaps of the last 30 days is the gap stat. If the gap is more than a gap stat, it is a large gap. If it is smaller than that, it is a small gap. If it's large, it's a big day. If it's small, it's a normal day. On big days, I want to emphasize day trading because I want to get the predictably larger move of the day is going to be very good for all of my day trading systems, which are based on taking risks of the normal day. So when I come up with a frog box, that is the average. If I compute the average range percentage of the last 30 days and then take the standard deviation, that equals a frog box. If this thing has consistently moved that percentage every day for 30 days, the amount of variation is small. That means I can more reliably predict that it's going to move that far. So I want to trade it with a small unit of risk. I use the risk of the standard deviation. That is the frog box. If that thing moves large days, medium days, small days, and it's all over the place, the standard deviation is large, the frog box is large, it's not a good day trader because sometimes it doesn't move at all and other times it moves like a scalded ape. That's unreliable. I want things that reliably move like a piston in a cylinder. I don't care if it's up or down, as long as it's moving that standard range and the frog box is small. Now suddenly, how many frog boxes, we take the average and divide it by the frog box, in other words, the standard deviation, and that gives us the frog index. That's nothing more than a t-test to talk about the reliability of getting that much move. If I get 3 to 1, that means there's 3 frog boxes inside that. That means I can risk 1 off the low of the day and have an expectation of getting 2 if it just moves an average range. That's the entire theory behind frog trading. And it's based off of the computation of a frog box. So that's the definition of a frog box. It is the standard deviation of the last 30 days The average range is simply the average high minus low. A range stat is the average range plus 1 standard deviation. So if this is my average range and this is my standard deviation, then if I take the average range plus 1 standard deviation, that accounts over the last 30 days. 85% of the days, or 5 out of 6 of those days, moved less than a range stat. Why? Because math. That's what it means. When you take a normal histogram and you take the average and plus or minus 1 standard deviation, about 1/6 of the data falls inside this range. About 1/6 of the data falls inside that range. So if we rotate that 90 degrees and we have the low of the day and we take the average range, that means 1/3 and 1/3 is in here, and 1/6 is up here. That means only 1/6 of the time did it ever move further than average plus 1 standard deviation. That is the definition of an abnormally large move. So I say that the limit of a reasonable move is 0 to average plus 1, and we're going to call that normal. And then this is abnormal. So when I see a low of the day and it starts moving, and I put a frog box on here, I know that I have a reasonable expectation that this thing can move to the average, and it could move one more to the range stat. That is the upper limit, the maximum reasonable intraday move is the range stat. So now, how can I find the low of the day? Well, I know what the low of the day is. Hey, when this thing starts failing from the open, how far could it go? Come on, pen. I go back 30 days and I compute how far in the last 30 days on a percentage did it go from the open to what turned out to be the low of the day. So I know what that is. So I count that for 30 days. Day minus 30, day minus 29. So I count that for 30 days, and I take the average percentage that it falls. So now, when it opens and that thing starts selling off, I know where the fail stat is. That's where, on average, that thing will turn. What does that represent? That means all of the routine traders who trade that have typically moved it that far before they stopped selling it, and then they began buying it. So if I see something come down to here and it gives me a 1, 2, 3 entry, and I know that the frog box from the low of the day is here, you bet I can buy that. I can just say it's moved a non-noise unit off there. I've got 2 to the average and 3 to the range stat. And that's about how far it moved on average anyway before it started reversing over the last 30 days. So there's my intraday template. I know where the fail stat is. Hey, what's the fade stat? The same thing. High of the day to the close of the day. If that's the high of the day and it starts moving there, how much do they give back on average? That much? Is there 2 to 1 available? If so, I can fade that. I have another one. Hey, where's the VWAP? Is there, from the high of the day, 2 or 3 units of risk back to the VWAP where it typically closes? Yes. Now what I have is I have a template for standard work for a normal day based on math, and now that gives me the ability to describe reasonable moves intraday so that when I go back and I start trying to answer these questions, what do I see? Where could it go? What is it doing? Which way do I want to trade? I can start using math and standard templates and standard pieces of work to start making a trade template to trade in a statistical way, to know if I am using reasonable assumptions about where it goes as opposed to what my stomach wants to feel. I want to use industrial strength templates to justify taking a businessman's risk. What I just described was standard work for my chief of staff or my foreman, whose job it is to manage risk and make sure that the monkeys are trading safely. So that's the frog box, that's the range stat, that's the 1, 2, 3. The concept of standard risk is whatever I've decided. If I use a frog box, that is a measurement of a standard amount of risk. If I take the range stat and divide that into 10 equal measures, the range stat divided by 10 is the smallest unit of risk that I can take, and it is quite often the MMRB. The minimum manageable risk box is a practical measure of an amount of risk that if I took it, I can reliably get out of that trade with slippage. After I make a decision, I get slippage, and I will not take more than 1 unit of risk of loss. So it's 1/10 of a range stat. And now remember, the frog box on the things I'm trading, the range stat is going to have like 4 of those, 4 frog boxes, because I'm trading it with a frog index of 3. That means the average risk, or the average move, had 3 frog boxes, and the 4th one got it to the range stat. That means 4 MMRB or 4 R10s equals a range box, or a frog box. The R10 equals 1/4 of a frog box. That now gives me a very calibrated way to judge how much is reasonably available in a normal move if I can squeeze my risk down to that standard unit. I always know what that standard unit is. Standard work means is that I can take a standard risk and I can turn that into the MMRB. It also is how much risk per trade. That is also standard risk. That's how much I prototype with so that I have skin in the game when I want to test it for real. And when I go to full rate production, I have $400 of risk per trade. That means half a risk is 200 and low risk is 100. Round numbers. I know how many, and I know what the size of that is. I know exactly how many shares I'm supposed to buy here, here, and here. I don't have to see a pattern and then decide, I wonder how many shares I'm going to buy. I wonder how much risk per trade I should put on that. I know what that number is all week. All week I know what that number is. That's 2,000 shares in Brazil. That's 1,000 and that's 500. Those are the increments that I buy them in. I'm probably never going to change that because I've been trading that way for 20 years on Brazil. So the MMRB, the minimum manageable risk box, comes from the world of practice, which says once I incorporate slippage and the spread, and I see a signal to get out, there's my signal, and then I execute, and then I get slippage and spillage, I'm still not taking more. That's less than 1 MMRB. That's from the world of practice. It's also 1/10 of the range stat. I know that when that thing starts rolling over at the top, and I hit my 1-2-3 exit or my sniper exit, I'm not taking more than 1 MMRB from the top. I know that. So that's the R10. Hey, what's the R6 and the R3? It's the same thing. Sometimes you will feel like when you approach this from the math side, you'll say, hey, the range stat is that big, and the R10 is too tight. Makes me nervous, okay? Make it the R3. That's pretty close to a frog box. Hey, take half of that, and that's the R6. So the range stat divided by 6 is the R6. The range stat divided by 3 is the R3. The range stat divided by 10 is the R10. Check or hold. The average win,
Check.
the average range divided by the standard deviation is the frog box. That's the normal. That's the normal day. This is the definitions of all of those pieces.
I have a clarification there.
Yeah.
So the average range of over the last 30 days divided by the standard deviation is the frog box, or is the standard deviation of the
Frog
average
index.
range?
Frog index.
Index. Okay.
Average range divided by the standard deviation. So the frog box is the standard deviation. What this tells you is for an average range, how many frog boxes can I fit inside the standard range? Or I'm sorry, inside the average range. If that number is 3, then the frog index is 3. The range stat is the average range plus 1 standard deviation. So when you look on the daily chart and you see the frog quality number, that's the frog index, and it says 3, you will see that that thing is highlighted. Why is that? Because that means that just on an average day, on an average range, you could risk 1 frog box from the low of the day, and you could reasonably get 2 to 1. That's why it's highlighted as green. But what I use as the upper limit for the maximum reasonable intraday move is the average range plus 1. So now if I have a frog quality number of 3 and it has a range stat of this, you know, on a frog quality number of 3, there's 3 frog boxes inside of it. And I take the range stat, which is plus 1. Now there's 10 R10s inside it. That means essentially that the R10 is about 1/4 of the frog box. That's how small and tight that is, right? So if you're using the R10, you don't even have to worry about, I wonder if there's a 2 to 1 reward to risk ratio based on execution. Oh yeah, there is. And in fact, there could be a massive move if it just makes an average move today. So now when I'm working this during the day, from the open, there is a plus range stat and a minus range stat available reasonably each day from the open. So if this thing opens, let's say it closed here, and then there was a big gap, the fact that it was a bigger than average gap tells you that this could be a huge day. The kind of day where you could get a range stat. And 2 days out of 5, the open is within 10% of the low or high of the day. But this thing just gapped up huge and it's starting to go. That's the low of the day. I'm willing to take an R10 off of that and say, let's go. Show me a range stat, because that's going to be a 9R trade on one position. And if I take a 2R battle drill and a 2R battle drill and a 2R battle drill, and then I exit at the range stat, that thing's going to be 9R on the first one, 7 and 5 and 3. That's a 24R day if it moves uninterruptedly just to the range stat. Hey, guess what happens if it moves beyond a range stat? This could be one of those 1 out of 6 days that gives you more than a range stat. So go back the last 200 days and find out what the max win was. You're going to discover that it's 2 range stats. That could be a 48R win. So do you think I worry about losing 1 MMRB that day if it gaps up and goes and then just drop? No, I'm just going to take one anyway. And guess what my fireman is doing? My fireman's job is to get this to here as fast as possible anyway, so I'm not even losing capital. Let that sink in. Listen to this last 10 or 15 minutes 5 times a day for the next 30 days. 1 time a day for the next 30 days. That's the entire workshop. Don't believe me. Watch what I'm doing on the hybrid swing. All I'm doing there is trading a 30-minute bar. And then every so often, on the ones that are really moving, I'll dial down to the 3-minute and try to focus on a couple of them. And that gives me the sniper trade of the day. And these are all managerial trades. Hey, the manager, the chief of staff, and no sniper involved at all. The sniper's doing this one because of those numbers. Until this trade gets past 2R, the sniper is just go to sleep. Be well rested. So I'm watching all of those things that I started. Which one gets to 2R first? I could handle maybe 2 or 3 of those before my span of control blows up. I'd really just like to handle 1 or 2. I'd like to handle just one and then watch another one to see if he's coming into a critical state. So if they go into a critical state on the 30, alert the young trader, alert the young sniper, something like that. Okay? All right, so we've gone 20 minutes over, but it was probably worth it. And the guys in the... we didn't even have any of the... or do we? Oh, Damien's in there. That's good. So we had a few of the creativity guys. So that's what I want to say about that. Any questions on... Let's see, the... Frogbox range stat 1, 2, 3 entry, standard risk, MMRB, R10, 6, and 3. Range risk, I need to say that. That comes from the swing systems. And if yesterday's bar looked like this, That's yesterday stalking. The range risk is 5 cents above and 5 cents below yesterday's high and low. This creates the yellow zone, and this creates the green zone and the red zone. And in the yellow zone, I can only trade if I can see 2 to 1. Like if this thing closed here, but it gapped open to here, and then it sold off a fail stat, but didn't take out the low of yesterday and starts to reverse. Well, I can take that trade to the top of the day if I wanted to, because that amount of risk is offset by 2 units of reward. If I can see that, then and only then can I trade inside of yesterday's candle. If yesterday's candle was the tiniest little doji you ever saw, you're never going to see a yellow zone opportunity, because that is so small, you're never going to get it. But that's okay, because in the green zone, I can take this as a mechanical entry for my swing systems, because it just got to a price that it couldn't get to yesterday. I have new information that buyers are coming in and want to take this thing north. So on something like a 5-day down, and I have a 10-day high up here, and I define that as my reasonable target on a swing trade, and if my mechanical risk was this, that means all other things being equal, if I bought it there and I just used the yellow zone, yesterday's range, as my unit of risk, because it takes new information available to say, this thing is now failing more than it failed yesterday. That means in the red zone, I automatically want to be short. So if I had a 5DD that ended up here and it broke, I'm trading the 5DD failure pattern. I'm going to be short here with a mechanical risk of 1R, and I guarantee you that whatever this was, that's the symmetrical move, and there's at least 2 of those available, because it just recently did that. So my 2 to 1 on the downside is justified, but my reasonable move to the upside on a 5DD, with this as my unit of standard risk for that swing trade, is the 10-day high. So how many of those mechanical risks can I fit between the 10-day high and a mechanical entry? That is the auto framer. If you look at the weekend report, how many of the Dow 30 and the ETF 30 are better than 2 to 1? Almost all of them. They're between 3 and 5R. That means just using a full daily risk and a mechanical entry, I have reasons to get into that as a swing trade. I have evidence that new buyers are coming in, And they see the same thing I do, which is a very favorable reward to risk ratio, and they were willing to buy it here. Guess what happens if that thing gapped down into the yellow zone and I could get an intraday trade and earn 2R, and then it goes through the mechanical entry? I can use the money that I made on the intraday trade to fund the overnight risk on the swing trade. That is hybrid trading. That is core and turbo trading. That's using the intraday turbo to generate money to pay for the overnight risk on a relaxed swing trade. That's the hybrid swing trading course in 10 minutes. Check or hold. That's what I mean by standard work. Mathematical definitions. Do routine things routinely. Periodically calibrate and adjust your gauges. Become an industrial production machine with no feelings. Eat feelings for lunch and breakfast and dinner and dessert. Use the principles of Dr. Deming and TQM. Use the principle of the Toyota production system, Kaizen in the Gemba, to make continuous improvement. Understand the principle of the standard day so you know where my statistical measures are being taken from. Understand what mechanical risk is, that's for swing trading, is yesterday's range with a buffer of 5 cents on either side. That is the range risk. And I can take that mechanically. The mechanical entry is if it just goes through yesterday's high plus 5 cents. How much more information do I need to tell me that new buyers are coming in? I don't need any more information than that. Since we got some extra time. On all of those mechanical signals, for you guys listening right now, I'm not going to even allow you to take the swing course. Yeah, I am. My reasonable price target, 10-day high. That thing gave me 5 days down, or it was a triple screen, or it was a washout, or it was a channeling system, or it was the overreaction system, or it was the 551W system. They all ended up with a range risk, a mechanical entry, and a mechanical exit, and then a favorable reward to risk ratio if it goes back to the 10-day high. Hey, here's how I think about it. If it gets up here in 1 day, that's an A trade. When it gets to the 10-day high, I don't believe in it stronger. That's a test. Before, it could only get to that level before it sold off. So I'm not going to add because it has to get through that. How far? I don't know. Half an ATR? 50 cents? So that I know that it's actually blasting through. And then how high can it go? You tell me. Use the regression lines. If it gets that far, that thing is gone forever. But that could be an A trade. Here's my stuff. And these things normally work in 5 days or less. If it doesn't get to there in 5 days, that thing's failing. How long am I going to stay? Well, it's good enough to stay in. It's not failing, but God dang, the PSAR is going to time that out. It better stay ahead of the PSAR, or I have a mathematical reason to get out. So the composite, I think that's a B trade. Yeah, it's good enough to stay in. It's good enough to stay in, but watch the PSAR like a hawk. After 3 or 4 days, it ain't working. That's my mindset. And then these are all the different swing systems that have a different idea on how to get into the position, but they all have a single method of exit and management. It's this and those exit rules. Many ways to get in, one way to manage it and get out. Very efficient, like an industrial machine. 10 doors in, 1 door out. And everybody has their job. The auto framer was what I was using to determine if any of those signals were good enough to trade. And then I realized after 5 years of doing that, oh, the auto framer itself, simply on the basis of trade location, tells you if it's good enough to trade. You don't even have to have a specific reason. The trade location itself is reason to trade it. And I know how to get in, and I know how to manage the trade. That's where the second generation of RLCO, like SSC and Owls and the auto framer and have come about. That's even easier. I already know that if the swing systems fire, I'm going to have a favorable auto framer. That's just an extra reason to love it enough to trade. But the auto framer itself is the first thing that I look at. You know how you get a big auto framer? You have a small yellow zone and a large sell-off. If this fails, guess what? The large sell-off is going to happen again. If you have a small risk box, guess what you have? A large position size. What do you want? A large position size on things that will be large in either direction. If you have a doji and a good auto framer, you don't care which direction it goes. You don't have a directional bias. You can forget the directional bias altogether. Let the hobbyists and the amateurs worry about that. The auto framer is your friend. Go look at the daily report and look at the ones where I have highlighted better than 2-to-1 on the auto framer. And if you want an extra juice, it's good on the auto framer and it's good on the squeeze, which means that the daily range is less than 80% of average. So you know it's been squeezed, and you know that the auto framer is excellent. You don't need anything more than that. If and only if you adopt this mindset of industrial production and machine trading. Now, if you do, your job is to go from beliefs into evidence-based trading. All of those beliefs you have about trading, not needed. They're getting in the way. If and only if you adopt evidence-based trading. What should you do as you begin this journey of learning? Well, I would say, let's see, hopefully I have it on here. That would be cool. That'd be cool as shit. I would say that what you should be doing is replacing your beliefs with evidence. I think that starting today or whenever you started this process, your 0 day, today, you replace your beliefs with evidence, which you gather by taking action in risk adjusted ways. And as you get evidence that shows you getting up the hill and doing better through action, you create beliefs based on evidence, and then you lock those in to form a wedge that's strong enough that prevents you from backsliding with your actions. You create checklists and rules and accountability that act as a wedge to not let this thing backslide. And then you just keep making small improvements with continuous improvement through Kaizen in the Gemba. And every so often, the big idea, Kaikaku, to get a big jump up. And otherwise, you just keep munching along. Big jump up, and you lock that in. That's the idea behind ruthless risk management. Don't give back big gains. Take prudent, justified risks. Once in a while, you'll get rewarded with a fat tail. You didn't do that. That was just luck. You got lucky because you were prepared. Don't take your eyes off the prize. All right, that's everything I got. Final questions.
It's not surprising that I have a question, but how would you, because I noticed on the daily sheet you rank symbols based on the TVR, but then some of these symbols have high TVRs, but then low FQNs.
That's one. Here's what happens. What if you think about how do you get that? I'm actually going to give you that as a quiz. How can you possibly have a high TVR and a low frog quality number? Well, here's how. Correct. You had a bunch of large regular percentages. Your range percentage was large compared to all the other members of the population which had these. So you had a large routine percentage. Check. And while that was routinely large, you got a small standard deviation, so you also got a large frog quality number. But then you had 2 days of massive gains. That actually makes your average range percentage go up. But that variation made the standard deviation suddenly get way large, which drives your frog quality number rapidly down, which means that the offset, the 2 days, was not big enough to drag the average range high enough to compensate for the... So what that does, it says, for those 2 days, because you were trading it because of the large TVR, you got massive goodness, potentially. But that was so abnormal, maybe you want to just be careful. Calm down for a couple days. Let that thing get back to that normally large. But if you understand this, the time that you want to trade this is now. For as long as this thing is huge, because you're getting the benefit of it. You'll see that in Tesla all the time. In fact, no matter how big those are, it never goes back to lower the residual large percentage. That's how you get. You saw that. I'll tell you the best example of that was Intel. Intel had 2 days of just ridiculous gains, and now it's come back to something like normal. So the trading value will always get you onto the ones that have reliable big volatility. Just know that if they have an even larger day, a double range stat day, or they had a big gap, it's normally a big gap, and that'll drive it large, right? You'll have a couple days where it's really big. Just maybe just trade that at half the size, or just be careful. But for me, that the large average range percentage with an R10, come at me, bro. You know. So that's how you get that. Okay? Yeah. So for the new guys here, Dwight, Jonathan, I don't want to discourage you from a year from now taking the taking the other courses. But there's about 20 hours to unpack in that last hour and a half, I would say, of little components. It came at kind of bullet speed. But you should take those in small bites. A bunch of fish just jumped into your boat. Study them one at a time. This one, to me, we built this picture. We built in the last Foundations course, or it may have come from the Creativity course. They tend to converge. But it captures the top level difference between me and the beliefs based teachings of Dr. Tharp. I'm a Kaizen guy. I'm telling you that forever. I will never not be a Kaizen guy. The small scale, continuous improvement, working like a beaver. That's all I'm ever going to be. Van worked on this side. What he did was essentially use magic, which is any technology sufficiently advanced that you can't explain it, according to Arthur C. Clarke. And through magic, or the super trader process, through experiential evidence, if you will, create a new set of beliefs, then design a system based on those beliefs, and then use feedback and accountability and analysis to determine if it was good enough to trade, probably back testing. And then if you do as I suggest, trade that at small units of risk so that you use the results of the system to scale the amount of dollars at risk per trade. Then you let the system earn the increase in position size. Here's where super traders that have ever blew up. They started with beliefs. They designed a system that must work, maybe even passed the back test, and then instantly went to a level of risk per trade as if this thing was already performing abnormally well, optimistically. So they were trading well beyond the maximum limit of reasonable risk because of the transformational belief in their new beliefs. So even if you use magic, and I mean that in a positive sense, if you use the super trader magic to have upgraded your beliefs, I insist that what you should do is trade one share live right now and find out what it feels like to trade it with live money forward with skin in the game. It costs you $1. Trade it 500 times at $1. If you lost $1 100% of the time, you'd be down $500, and you'd know something pretty important about that system and about how you respond to adversity as a trader for a mere price of $500. But guess what? It won't take you 500 losses in a row to learn those lessons. Hey, even if you just split it and you were 50% wins and losses, you net zero, and you're going to know more from 500 trades than from 500 back tests. That's my hypothesis. But what I want you to do is trade one share live until you can trade $10 live, and then you figure out how many shares that is based on what your risk is, until you've earned enough money that you can trade $25 a trade, because the $10 was so positive that the size of the portfolio increased, so that, I don't know, 1% is now $25. You let that system generate evidence to start scaling. And once you go from 10 to 25, you now know how to increase the dollars at risk per trade. If you do it that way, never change the architecture. Never change the architecture of the trade. Like if you frame that trade and you're supposed to take $1 risk, and you did, and you earned money, and you were trading $10 at risk with $1 at risk, and now you want to go to 20, don't suddenly change the architecture so that you're only trading 50 cents of risk. You have no evidence that that trade frame works with 50 cents of risk. You have all the evidence you need that it works at $1 at risk. So don't change that. Don't change the architecture. Don't change the frame. You have evidence that that frame works. All you got to do is change the dollars at risk per trade, and then make that standard work. Hey, I've got 3 different swing systems. Trade them all at standard risk. Now I've got a 4th unit of risk to put on. Which one of those has the higher expectancy? Let that one increase. Hey, I got a new system. Put them on 1 share live, then $10 at risk. That's limited rate production and prototyping until it becomes a full production system. Once things become full production system, you're trading that routinely with rules in a completely disinterested manner. Hire somebody to trade that for you. Be done with it. Spend all your time inventing or discovering the new rules. You know why? Because the market is an open, dynamic system, and all those things that are in production may become obsolete. What do you do when they become obsolete? You paper trade them until the expectancy gets positive, and then you scale back in. Because the market will come around to that idea again. But if you don't have a way of checking that, you'll never know when it was time to get back in and start using that system. You're just always looking for new systems until you can throw it away. Don't throw it away. Ideas inherently are not good or bad. There's only a time and a place for them. So that's a belief that I have. That's a belief based on evidence. All right, so that's what I want to say about that. Now, I want to respect the fact that Kyun and Chun Long are here for the Creativity 202 course. Now, you other guys don't get to ask questions. They get to make comments for Creativity 202 if they wish. And I'm going to turn it over. And It's not going to hurt them to have listened to that last 45 minutes. But it's good to see you two guys. What you got? One of you start. Chun Long, how are you doing, sir?
Very well, Ken. Sorry, I haven't checked in for maybe about 10 weeks. Just come in to report my progress.
Yeah.
I'm not leaving. Actually focusing on my trading and use your approach. I also see you are doing well. Congratulations on your health
Yeah.
recovery.
Thank
I
you.
hope.
Thank you. How's your trading going? Hey, don't tell us now, but what I need you to do is prepare your presentation for the research weekend. I want you to use the next couple of weeks to start documenting where you are. And I want you
Okay.
to share that with me. You don't have to publish it if you don't want to, but it wouldn't hurt you to do that. But I want you to go through the discipline of preparing those stats. Work with Luke on how to do that, uh, and that will be a good discipline for you. If
Yeah,
you're well, if
may
you're
I,
well.
choose one of my,
Oh yes, sir.
I may not present my trading, but I want to present something I do.
Sure.
For past 5 weeks, I actually generate a big spreadsheet, basically to replicate what you put in the daily report and the weekly report.
Yeah.
I know I can generate maybe 90% of the contents, put that into coding into the spreadsheet. It's really helped me to understand all those systems, including the saving trading systems,
Yeah.
including the BMR, including ETF2. Also, those intraday stats, like what you said in the past 45 minutes.
Yeah.
Can I present that?
Please do.
Okay,
I
thank
mean,
you.
right now we're in the week on the research weekend.
On the research weekend.
Oh, okay. Yeah, sure. Yeah, that would be good. That sounds good. Aho.
I hope, yeah.
Kyun,
Okay.
how are you doing today, sir?
Oh,
Oh, sorry, I had trouble unmuting, so now I think I'm unmuted myself. I'm very good, thanks, Ken, and it was really great to be listening on the last 45 minutes. I've been, doing some work on the gap stat and the fail stat and those things. So, right on cue, you're talking about them, and I think, for me, I think the others have left, but for me, it's taken all this time to really appreciate to understand how I can use those things. I mean, when I came across them maybe 9 months ago or whatever, okay, I get the theory. But, if you don't trade and you don't actually do like what you were saying, put the evidence in and trade whatever it is, $1 per share or even pay per trade, uh, I didn't learn. I wouldn't have learned what that meant. And now they make a bit more sense. They make more sense to me, and I know how I can use them because I have actually started using them in the sense that when the session starts, I now start thinking about them because I've got I can calculate them or have them up on my screen. So I've started using that. I mean, I can't say I'm very proficient. I don't use them all the time, but at least I've started thinking that way.
Yeah.
The
Yeah.
gap stat, the range stat, the fail stat. I say, okay, where are we in terms of that? Where's the gap? Is it a large gap?
Yeah.
I've started thinking that way during the session.
Yeah. It will take all the joy out of trading for you.
That's okay.
It really does
It's money.
because now you're like a machinist at a CNC
Yeah,
machine, and it's just you're just setting the thing up, and it's going to go this way, and it's go that way, and just you have to replace it with a different kind of joy. It's not the
sure.
thrill of the thrill of victory and the agony of defeat. It's all of that gets replaced with the quiet happiness of a craftsman playing
Yeah,
around with his tools and tightening up using a torque wrench. You have to find the use of a torque wrench to be
yeah,
extremely satisfying to understand the joy of a mechanic. I mean, there's not a tool that's more beautiful in my mind than a torque wrench.
torque wrench.
You know what I mean? Because the only thing that's holding that structure together is friction.
Mm,
I mean, damn, it's friction. Is keeping it from slide, and that's just is that thing sliding or when a bolt is turning, it's sliding. It's overcome the metal to metal friction. So how tight do I have to make that? But not too tight, or it'll break. Because when it's too tight, then all of the shock that metal is supposed to bend and flex within a certain range. If it's too tight, it can't flex, and then it breaks, it snaps like a crystalline structure. It lost the pliability. So when you tighten it up a certain amount, you're putting just enough friction to keep it from sliding under normal conditions, but not so tight that that'll just snap. So a torque wrench captures that whole idea in a beautiful way. And that's why it's my favorite tool. Because it stops you from just over tightening and snapping it off the nut, or the bolt. Which, if you're a monkey, you've done that before. Or if you've rounded off the nut because you over tightened it, and now the soft metal of the nut couldn't handle the hard metal of the wrench, and the force was too much, and now it yielded like butter. So that's what a torque wrench does. Yeah, and that's what all these things do is they start accommodating that mechanical sensitivity, the touch of the craftsman. You don't use the whole tool set. But you have the ones you need and the ones you can, and you immediately, when you become that proficient with those things, and you see a task that needs to be done, it's not even a problem to overcome anymore, because problems feel difficult. Oh, it's just I gotta loosen that nut, but it's rounded off, so that means it's gotta use a different tool, and then the tool suggests itself, and now you've made the connection between the local situation, the end state that you want, the conditions, your skills, the tools you have available, and now suddenly, like magic, the connection is made. That's what the creativity course does for us, by the way, is giving us new kinds of mental models and concepts to work on that allow us to get unstuck. And then we eventually find the right one. So, yeah, so that's good to hear. And I would give you the same invitation that I give to Chun Wong. I think it'd be good for you to have a a temporary wrap up. The annual report. The wrap up session. In your trading journey, kind of where you are, where you've been, where you're going, things you learned along the way, in the form of a story. I think you would, and as a learning journal executive summary, like on one sheet of bullet comments, I bet you would find that to be, even if you put it in the frame of plan, prepare, execute, assess, sustain, improve, and action, just that one wrap up slide would drive actually a 2-hour presentation. That once you got into it, you'd realize it would, but you don't have to. It's 15 or 20 minutes, one slide with that on there. And same thing with Chunla. I think you would benefit from the doing the math, but if you also wanted to do a top level one, that wouldn't hurt. That wouldn't hurt you.
When is the research weekend?
What we're
You
going to
said
do
a
is
date?
we're going to collect commentary, collect presentations in October. When
Okay.
you're ready, just schedule it with me. We'll record it. We'll put a bunch of them together. Let everybody that wants to watch them, and then announce like some kind of joyful session to come in and do a 3-minute check-in and things we want to talk about or give questions or whatever. But we're going to do it. I still mostly asymmetrical, but just because of so many competing time frames. So use the month of October to generate it and record it. You can do it with me or with an accountability partner, whatever is more comfortable. I'm happy to do it, but whatever makes you more comfortable. And then we'll do the month of in the month of November. We'll figure out how to do a series of sessions. Like we might do 2 or 3 people in a 2-hour chunk, just to sort of highlight it and ask questions. And that way we start with everybody has sort of already heard the deliberate delivery and maybe even has some questions and maybe even send them to you. But then you get 10 or 15 minutes to hit your highlights and they address questions and answers. And that we'll do that in November. And we'll record those so that you get a chance to hear all of them. So I keep saying I'm going to put that in writing, but it's now October. So I guess I got to put that in writing today. So there we are. That sound all right?
Yeah. Sounds
And
good.
Damien, what you got?
Um, is there a possibility that I could share my screen, Ken?
All you got to do is share it.
Oh, it's already done. Okay. Let me see. I want to make sure I have the right screen because there it is. Can you guys see my screen?
Yes, sir.
Okay, so I presented this partially to our accounting build yesterday afternoon. So those are basically the statistics, Ken, for the month starting mid July to the end of August. You can see that my R wins are 63% and my losses are 36%. And the biggest problem that I have, as you can see, is the losses. The losses are minus 125. So if you look at the whole month, it's basically a loss. It's a small loss. The average loss is 0.06 R's per win. But when we go to September, we're getting closer to what it's supposed to be. The average R win is 0.8, and the average R loss is reduced to 1.08. But my win rate is still basically 2-1, which is good. So I have to work on 2 things, is reducing my R losses to less than 1 R, and I have to learn how to let my winners run for a longer period to be able to get a higher R. So that's basically what the statistics have showed me over the last 2.5 months. But I'm on the
Let me
right
stop
path.
you. Let me stop you right
Yes.
there, and let me say this: the precondition of that is that there really is more R in the trade available, but that you are getting out before that R shows up. I don't
Yes.
know. I don't know that that's true yet. I mean, it sounds like, well, I'm going to stop taking my exit, and it's just going to keep going up. Well, that's a separate research question.
Okay.
The question is, after you take the exits you're taking now, what is the performance of the trade after that exit for X number of bars? Is it really continuing to go up? Or is that, in other words, is there still gold in that mine? And the reason you got to answer it that way is because it might be so good that all you should ever trade is the second trade and use the first trade as the alert, and then look for twice as many opportunities to trade the second entry.
Okay.
Or it may be that what you have is the price action after the first exit routinely goes further and then reverses and then also goes higher. That's actually the preferred condition. Because now what I
Okay.
have is I have the first exit where I give back 1 unit is protecting me against an average loss of 2 units. But then I can get a COTA 2 reentry and get the second leg when it materializes under the same risk managed conditions. So that's a different case. That's the idea behind the trade index analyzer, which says if my normal trade has been lasting time t, what's the maximum favorable excursion and adverse excursion in the 2t time frame?
Okay.
Let me see. I may have a chart on that one. Looking. No, I don't have one immediately available. Darn it.
That's okay. I
Yeah,
understand what
but
you're saying.
yes, yeah. So yeah. Anyway, it's a good thing that you are reducing the average loss on the first trade. It's still too high,
Yeah.
but you're heading in the right direction, and the increase in gains on the first trade was also in the right direction, and you actually improved the winning percentage. So that actually told me that there were some micro losses that are turned into micro gains. So that's actually helping because you made about a 25% improvement in that little piece. Don't know that there's enough R left in that first trade, although it's positive expectancy right now. But it's so narrow margin that we want to build in more. So what you got to do is go back through your charts on your closed trades and start looking at the maximum favorable and adverse excursions after the first exits. Because what it may be the case, the re-entry to the long side or the continuation trade or re-entry to continue, maybe that's where the gains are. Maybe the stop and reverse, or maybe the stop, wait, play the failure is where the gains are. It may be maximum adverse excursion is happening after your exit. So what you're doing is you're searching for R after exit number 1, which is already positive expectancy. What you got to do is make sure that you're not getting rid of the positive expectancy by trying to come up with some composite rule to change exit number 1. First, find out where the R, if any, where is the R after the exit?
Okay.
Is it in the same direction? Is it in a reverse direction? Is it equally split? I mean, and then we have a whole new trade. So that's the research question to answer.
Yep,
But
I
you're
will
heading
take
in the
care
right
of it.
direction. Yeah. Okay. All right, that's all I got. And
And I appreciate your feedback. I didn't think about that, so now I have homework to do, which is good. Like homework.
Yeah.
And when I have the answer, I'll report back.
all right, fellas, sounds good. I think for the in Creativity 202, the normal timeline is those guys in that last cohort have reached like less than 30. I think only Jeff made it all the way through kind of on time. But there is a new student starting, and there's only one. I just I'm obviously a poor salesman of that course. It's the best course that there ever was, I think, at least for me. Uh, but so anyway, there's a guy getting ready to start on lesson one, and you guys, you're always welcome, and it's wherever you are in the course, and as often as you like or as unoften as you want. Always welcome. And I wanted to make sure that you saw I had distributed the Harvard Business Review article that Fletcher and my student wrote that lays out how they are training the soft guys in detail with the Fletcher treatment. Now, we're doing the same thing in the Creativity 202 course, but Harvard Business Review published the article about the work they're doing with the special ops guys. In fact, what they're doing is one of the lessons in Creativity 202, which is the VUCA idea, the volatility, uncertainty, complexity, and ambiguity, and what you should do about it as a leader. And they have a nice HBR article on that. Anyway, that's in Patreon, and if you wait half a second, I can send it to you now. I know where it's on Patreon right now. If you want to download that thing.
Well,
Yeah.
you sent a link to that over
Yeah, I
the
think I
week,
did.
if I recall
Yeah,
correct.
but
Yeah,
I
because
also
saw
printed
that.
it. Not everybody can always access those links, so if you just wait half a second, I'll send it in the file. I'm going to transfer a file to you right now, and just get that done, because it's a pretty good darn article. Let's see. Yeah, how to be a better leader amid volatility, uncertainty, complexity, and ambiguity. And it should be coming to you here shortly. There you are. Yeah, so in the chat box you can download that, and you'll recognize a lot of the words and language in there. But yeah, Lieutenant Colonel Tom Gaines is one of my students from 3 or 4 years ago, who was inspired to get a master's in entrepreneurial thinking from University of Chicago based on the work he and I did together on his master's thesis. That introduced him to a professor who knew Fletcher. The three of us started talking about storytelling, and that professor said, "Hey, you ought to talk to my friend Angus Fletcher about story science and storytelling." This was when COVID hit. I said, "Well, I got nothing else to do. I can't go into work." So I just sent an introductory email to Fletcher, and then that exploded into doing the research project at CGSC, a couple award-winning papers, a presentation to the Army Innovation Council, adopting that lesson and his approach into the curriculum at our college, to him writing the book on that field guide to creativity for the Army, led to me doing the Creativity 202 course, which is leading to me writing another book on that same technique, but for healthcare workers, that I'm writing with my brother for hospice nurses. We're going to replace the trading and military vignettes with healthcare vignettes. So that's going to start helping healthcare workers. And it produced exercises for kids at the soccer camp, which Fletcher turned into a research project with school kids in Ohio, which he wrote a paper on that got published and won an award. And his wife has now started a business doing those techniques for kids in the world. So all of that comes from Lieutenant Colonel Tom Gaines working with me, listening carefully, and just enjoying what we were doing and seeing where it would go. None of this happens without that. And I think that without that Creativity 202 course, I don't know that I'm as prepared for life after the VTI closing its doors as I am right now. I've reinvented my entire business, started 2 or 3 other businesses with some of the students, and all of that was simply because one of my students was interested in the things I was saying, and we just followed the trail. So that's why I teach, not just because I like to teach, although I do like to teach. But it also turns out periodically to have surprises all out of proportion to what your expectations were. I mean, you want to talk about a 100R win. Meeting Angus Fletcher and going through all that with him, and has been great for the Army, great for me, great for him, and great for the soccer club. So, and great for our traders. So that's what I wanted to say about that. Anyway, enjoy that article. It's a pretty good one. It's going to be part of the. I'm rolling it into the Creativity 202, and I'm giving the article away to everybody I can. And I'm circulating it around the Army with a bunch of snarky comments like saying, hey, you know, we helped invent this technique at CGSC and we are not even using it. But at least we can take pride that everybody else in the world is having radical transformative results with our findings, you know, the ones that we're not using. So I put a bunch of snarky emails together to trigger some general officers to say, without saying it, look how stupid we are at CGSC. Because I'm fighting a deep battle against some of the leaders who have taken pride in ownership of some of the earlier versions of creativity, which are not nearly as good. But they can't let go of that to adopt the newer ideas because they didn't invent it. And that is just absolutely criminal. It's almost willful misconduct. It's at least gross negligence. So I'm battling against that as part of my contribution to the Army. I still care enough to fight.
When you have that course ready for healthcare professionals,
Yeah.
Let me know, because I can share it with Gina, and
Yeah.
maybe she can get you in at UPMC here
Yeah.
in Pittsburgh.
Yeah.
Because it's a big hospital, so it could be, you know, who knows what can happen.
Yeah, we will certainly do that. Hey, make sure she gets introduced to my brother Bill, because he's just started his new job as a hospice nurse regional supervisor, and he's supervising 100 nurses, hospice nurses, and we're writing the book for them and doing the course for them.
Okay, yeah, okay.
And so if you link up Gina and my brother Bill, then she can actually help us craft that book so it'll look sort of like the Fletcher book, but it'll be for healthcare. And then that will, in turn, drive the course. We'll call it Creativity 203 for healthcare workers.
Yeah, because like when her mother passed away in November of 2016,
Yeah.
I mean, she had a team of hospice nurses from here in Pittsburgh, you know, help with her mother and so on. So she had the contacts, and she's still keeping in touch with those people. So yeah, I'll let her know.
Yeah, let's do that. So I'm
You
glad
know,
I
and,
gave that. I'm glad I said that. So now you just witnessed another 2 neurons are going to be connected. And the best part of that is I don't have to do any of that work. The story did the work.
Well, that isn't that what I said yesterday? I mean, yesterday
Yeah.
in our meeting, I mean, I will be honest with you. This group of individuals that I'm dealing with now is, in my opinion, 1,000 times more powerful than AA was. I mean, it
You
is
can't
more
even
powerful.
you can't even predict it, although I can predict it now. You can't even imagine how good it gets. It's always astonishing, and it happens in every domain that I do it in, with traders, with Army officers, with doctoral students, with soccer parents, with soccer kids. Uh, Everybody that tries this on has the same experience after a while, that if they stay with it, it's like, man, suddenly the way it's like 6 or 9 months later, what the heck just happened there? Wow. So
But
I've given up being surprised.
but when Jeff and Jeff took a
Oh my
it took
God,
him a
Jeff
long
Southern. Oh,
yeah,
look
but
at
no,
the-
what I was going to say is
yeah.
it took him a long time to convince me to do statistics, what I showed to you like a few minutes ago.
Yeah.
But the statistics are so powerful because now I know what I'm doing wrong. I know what I have to look for, like you suggested, so I can improve my trading. You have to look at the facts. If you don't have the
Yeah.
facts, you don't know anything.
It's like
And
hitting
that is
yourself
very
in the thumb.
powerful.
It's like hitting yourself in the thumb with a hammer. You know, until you stop and say, "Oh, you just, oh, yeah, I'm in a high state of agitation. All I know is that my hand hurts and all that other stuff." And the statistics allows you to say, "Now, look at what you're doing. What you're doing is hitting your thumb with a hammer because you're holding it wrong, and that's why it hurts, because you're hitting your thumb with a hammer." Now, you can do whatever you want to do, but the fact remains is that you are not keeping your eye on the nail when you hit it, or you're holding it wrong and trying to strike it, but you're hitting your thumb with the hammer. The statistics removes all doubt, really, of where the problems are. It lets you just smoke it right out and say, now, you can fix it or not. That's up to you. Maybe
Yeah.
you enjoy hitting yourself with a hammer, but if you want to stop the pain, that's what you got to do. And then the creativity comes in and says, well, what are all the different ways that I can design to stop hitting myself in the thumb with a hammer? Discuss, The statistics, get you to that point. So anyway.
Now, do you want me, Ken, to do a presentation like
Yep.
Shulong and Quintu also for November?
Yep.
Okay.
I want you to do both of them. One is you're already well started down the path of the statistical treatment. And then I want you to do a summary of lessons learned and sort of the analog transformational insights. Plan, prepare, execute, assess, sustain, improve, action
Okay.
with your plan going forward, and the evidence that it's going to work because of the support network that you have. I want you to draw a map of your support network.
So what I'm going to do is I'll send the 2 charts that I shared with you guys to Luke, so he can give me some insight and have his insight also, and we'll take it from there. Sounds good. Well, I'm going to let you go, guys. Lunchtime here in Pittsburgh. You have a wonderful day, and we'll see you next week. Take care.
Take
Bye-bye.
care, guys.
See you,
Bye.
Danny.
And then